Well, with us right now is Dan Weiler. He is the president of Sterling Financial Advisors. Dan, always good to see you.
How are you? I miss your bow ties.
Well, every once in a while, I'll change to a straight tie.
There you go.
We're going to talk about something that people hear in the news when the stock market has a drop all of a sudden. And I think when people hear this, they seem to think this is sort of like kind of finance speak for calm down. It's called a market correction.
Well, there's
right?
market corrections and then there's bear markets.
Right.
Okay, so there's a difference between what is considered a market correction and a bear market. Market corrections generally are anywhere from 0 to 10, 12, 14% drawback of the market. That's not really considered a bear market until it gets into the 20% drop range. And so sometimes people think we're in a bear market when actually the market is just kind of correcting from maybe a hot run up or something like that. Or there's been some news. There's a lot of different things that can cause that.
Yeah.
In fact, yesterday, the big news was what's going to happen with North Korea. We lost 200 points. Okay.
Yeah.
That's not really a correction at all. It's just reacting to market news type of things.
Yeah, especially nowadays. For 200 points, back in the 90s, that would have been huge.
When we were growing up, 200-point day would have been setting records, So, and there's a lot of different reasons that a market will start correcting, and that can be that people are starting to take profits off the table. A lot of times it's the old adage of buying low and selling high. If we don't ever take the profits off the table, then they're really not our profits because they can be taken away from us very quickly. And so I had a gentleman in the other day. I actually got an email this morning before I came in, and he was talking about that. And I said, well, if we're going to actually buy or sell when the market is high, we've got a high market right now. It's not too bad to take some of our profits. It's kind of like going to Vegas and taking your original money off the table and then playing with their money. You can do the same thing in the market. If you've got a stock that's run up in value and you can take maybe what you invested into that off the table, then you're just playing with the house's money, so to speak.
Yeah, that makes perfect sense. And of course, this happens all the time, and we see this. And sometimes, I know you've talked about this, it might be triggered by one certain industry. We see that a lot nowadays, of course, in the tech industry may start that off.
Or energy, oil and gas industry, the car industry, a lot of bank finances, When interest rates started to go down, the finance industry stocks obviously went down because they wouldn't be making as much money because the interest rates were lower. And so they took a beating when interest rates were going down, but it's kind of leveled out now, and they're showing some decent returns based upon everything that was relative at the time. So there's a lot of things that can cause that. Corporate earnings reports every quarter, if they don't come in as projected, I've always thought that was interesting. Somebody else can project what you're supposed to be earning, and
how many times have we seen this with some of the tech companies, particularly Apple and Google, where they made a tremendous profit. But the people who predicted said, oh, well, it should have been like 2 points higher than that.
Exactly. They make billions of dollars in the quarter, and their stock gets hammered because they didn't meet the analyst projections.
And you're wondering, where did that come from?
So corporate earnings has a little bit to do with that. People's fear, we're starting to, the market's kind of went up a lot lately. When there's going to be a correction, I don't know. It's the dartboard scenario. When's it going to happen? But there's a lot of things that factor into that, becoming a correction versus a bear market, And so it all depends on what our goals are at this time as to whether or not we're going to kind of ride this market correction out, or if it gets into a bear market. Many times I have clients say, well, Dan, I want to wait till it gets back up to 22,000 or whatever it is, Well, a lot of times if it continues to go, they say, well, I'm still doing well. I don't want to sell now. It's kind of like the greed factor. Our greed button gets stuck a little bit.
Right, and you've made that point where, here's where the fear can come in, where people are going, on the opposite end, where they might be going, wow, this is going really well. I think I'd rather take some of my profits out right now. Maybe the market will keep going up, but they're a little bit more cautious. I don't want to say fear, they're more cautious.
What I have found is generally speaking, not all the time, but generally speaking, whether or not we earn 3 or 4% on our money or 8 or 10%, probably isn't going to change our lifestyle in retirement.
Right.
Okay, but if we lose that money, that becomes a critical part. And so what I find the most difficult thing is to get people to transition from an accumulation mindset into a protection mindset.
Right.
So in retirement, that doesn't mean we have to move everything into the bank or under the mattress, but we certainly ought to consider taking a portion of those profits off the table, maybe getting a little bit less return, but now having a solid foundation moving forward, so if there is a correction or a bear market, it doesn't impact our entire portfolio.
Right, and in the article that you sent me here, this book, it talks about how long will it take to recover from what would be considered a correction in the market. And what's interesting is, it says here the average for 1980 to 2016, the average market correction took an average of 87 days to hit the bottom. So it slowly started to go down, probably not even noticeable at first. Right. And took another 121 days to return to pre-correction numbers, which really isn't that much time.
Well, that's 3 and 4 months types things. Yeah. That's the difference between a correction and a bull market.
Right.
So for those funds that we have still exposed to market risk, we need to understand that this is a longer term type thing, that emotion shouldn't drive us just because we've lost 5% or something. Okay, it might take 2 or 3 months, and then, like you said, it turns around and ends up being another 3 or 4 months to make it back to where we were.
Which is not bad. We're as you know, in a bear market, it could take 2 or 3 years.
Well, yeah. I mean, to be honest with you, after the 2008 meltdown, it took about 6.5 years to recover. I mean, that was a big meltdown. From October of 2007, it hit a high of, I think it was 14,164. I know these numbers because I use it in my seminar.
It sounds so low now. It's like
14,164. It went down to 6,600.
Yeah.
So we lost 55%. So it takes a significant amount of money. And the thing about it is if you have $100,000 and you lose 50%, then you've got 50,000. But if you make 50%, you're only making 25,000 on the 50. So it takes a little bit more than a dollar for dollar return in order to get you back to where you were. So these are all things that we want to put together in our retirement planning process. We want to take some of these profits off the table, build a solid foundation so it doesn't impact everything if there was a correction or a bear market.
And that's the key.
Yeah, that's the key.
Right. And as you said, as we get older, as you get closer to retirement or within retirement, it takes a lot more time to recover those losses.
Our long, stockbrokers will say, hey, we're in this for the long haul, well, the long haul to a 45-year-old is different than the long haul to a 65 or 70-year-old.
Right.
Now, that doesn't mean we still can't participate in the market, but maybe in a little bit more conservative way. So, you make sure you don't lose those hard-earned assets that you've gained over all those years.
Yeah. So that makes sense. And we'll see when the next market correction it happens.
I wish I knew. I wish I knew.
Dan doesn't have a crystal ball, but he can.
Well, I do, but it's not working.
No, but he can help you plan for your retirement. And if you want to give him a call, the number is 949-859-8900. The website is sterlingfa.com. He is right up the road.
We do have our seminars going on.
When's your next one?
We've got one coming. I think we've got a couple next week, but throughout the fall campaign, we can get you some information for the bulletin board, and we can go
he takes care of you. You get a nice dinner, and you learn some valuable information. Good to see you, sir. Say hi to everyone, please.
All right, take care.
All right, we'll be back.